We're back. Let's do Ask Annex. Got a question? You head to our website, annexwealth.com. Look for the Ask button, and if we can help, just click that Get Started button. Matt Morzy is investment team manager, also a CFP. He is on the show. Hey.
Hey, Danny.
And we got Fred Coleman, CFP and a wealth manager. Hello to you.
Hey, Danny.
Two-parter here. Actually, it's two different questions. I'm taking a new job that has a 403B instead of a 401k. What do I need to know or ask? And the second one, similar, is I took a new job but really liked everything about my old 401k provider. Is that reason enough to keep it where it's at? Let's talk about that 403B first.
When it comes to the 403B and the 401k, they're mostly the same. The difference is really just the name and the IRS tax code, code 401k versus code 403B. Now, 403Bs are used for nonprofit organizations. The tax advantages between the two are the same. 403Bs do sometimes have limited investment options, and then 401ks have a little bit more creditor protection, so they're under ERISA. Most people say you can think of them as the same thing. There are some slight differences, but nothing that stands out in a major way.
How about this next one? Person's got the new job, doesn't dig the new 401k, likes the old one. Can they stay there?
You can't stay there. I'm a big proponent of always evaluating all of your options. It doesn't hurt to evaluate options. The two things that you look at anytime you're choosing between investments or investment companies is what you're paying and what you're getting for what you're paying. Usually the 401k is going to provide those limited investment options, and you're not going to get much as far as the tax planning, Social Security, retirement planning, all those types of things. If you don't need those things, then staying with the 401k company could be a good option because it's going to be lower cost, but it doesn't hurt to look at other options.
Yeah, what I'd be curious about is what's special about the old 401k. Is it something you're just used to having? You really like the website, you're just habitual about. You know, from an investment point of view, Fred, as you're saying, they're going to be very limited in terms of what's there, 10, 15, 20 different investment options. Most of those investment options are going to be available outside of that 401k as well too. Most mutual funds are going to have different share classes. So if you had a certain mutual fund that you really liked in there, they might have had a retirement share class in there that's specific to 401ks, but you could find another share class of the exact same mutual fund outside. That's not always the case. There are some that are built specifically for that. There are some special share types that are only built for that as well too, but likely you'd be able to find something similar. I would take a look at that. You also lose the ability by staying in there to have it actively managed as well too. So if you want help with those investments, like you said, you can look at the planning side of things, right? And if you don't want that, you could leave it there. But if you want somebody to manage it for you and have their eyes on it all the time, I would look to move it out. But again, you could stay there as well too if they'll allow you to, because sometimes they might kick you out and say, hey, you're a burden in our system. We only want active employees to be there, so you can't stay after a certain time period. And sometimes they do force you out if you're below a certain dollar amount too, where you might get a letter that says, hey, this is going to be liquidating at X dates if you don't do something prior to that too. But ultimately from my side, I'd be curious what was special about the old 401k, and you probably could match a lot of the benefits that you liked outside.
I never want you're a burden on the system. I'm sure that's coming. Next up on Ask Annex, the I-bond rate is 5.27% for the next 6 months. Sounds good. What are the downsides I should consider?
From my standpoint, there are a fair amount of restrictions that are on I-bonds. So if you're not already in, which is how I'm taking this question, is that you're looking to maybe add money to it. 5.25% or 5.27% is pretty good over the next 6 months. Can get similar rates to that in a money market. Difference is the money market, their rate could change at any point in time, especially if rates look like they might be getting lower. That's going to move faster down than the I-bond rate is. But from an I-bond, just from a standpoint is, and I'm sure there's more restrictions around this, but generally it's a 30-year maturity. You do have a 1-year minimum holding period that you can't take money out, so you lose a lot of flexibility in that first year. And if you take out money within the first 5 years, you lose 3 months worth of interest. So if rates go from 5.27 to all of a sudden they're down to 4 and maybe they're down to 3, and you want to take it out, well, you're going to lose some of that interest that you received during that time period if you take it out within those first 5 years. Other ways that you can use the same money depending on what your end goal for it is. Like I said, a money market will give you something similar right now. You can use treasuries or CDs to lock in rates, probably a little bit underneath 5% for shorter term loans. We do have an inverted yield curve right now, so you're not getting a benefit today of going out any longer than that. But you are also running the risk that, hey, if you have a 1-year treasury or a year from now in the I-bond, that rates are going to be lower and you're not going to be able to match what you thought you're going to get. So that's a risk there as well too. But, I would look at this in the, sake of the context of what is your end goal for this money and how does it fit into your overall portfolio?
Yeah, and I always look at what's the opportunity cost. I'm always looking at not only comparing that to cash options, but also comparing that to stocks, comparing that to bonds. If this is long-term money, even though it may be a smaller portion, usually putting that in stocks is going to be much more beneficial for you in the long run if you're okay with a little volatility. And the bond market is doing great as well right now. So looking at some higher yield bonds, that could also be an option.
Brad Coleman, CFP and a wealth manager at Annex Wealth Management. Thank you.
Thank you.
Matt Morzy, investment team manager, also a CFP. Thanks.
My pleasure.